Welcome to the 43rd installment in Trading Strategy Guide's Trading Education series. Today we're going to talk about moving averages. Here we go. Hi, this is Tim from TradingStrategyGuides.com. Thanks for coming back for this installment of our Trading Education series. Today we're going to look at some details surrounding moving averages. In general, moving averages are lines on your price chart that represent an average of a specific number of the last candles shown. So if your moving average is set to 14, it will show the average of the last 14 candles from the point at which you are measuring. It's called a moving average because as you progress through the candles, it adds the value from the current candle, and in our example, it drops the value from the 15th candle back from the calculation. A moving average can be calculated from any series of values. Typically, the value used is the closing price of the candle. However, there are some strategies that use other values from the candle, like the opening price, the high or low price, or sometimes even the volume. There are several different moving average calculations. And here's a warning. I'm going to get a little mathy here. I promise to keep it at a minimum, but you have to understand a bit of the math to understand each type of moving average. In my experience, there are two primary moving average calculations, each with its own advantages. I want to be sure you understand that there are also a few others. Typically, the difference between each calculation type involves how much weight you give more recent candles in the calculation. The first and perhaps the most common is the simple moving average, or SMA, or sometimes just called MA, which involves adding the values from all the candles together and dividing it by the total number of candles from which the values were taken. Secondly is the exponential moving average, or EMA, which weights recent candles slightly higher than older candles in the series, so the EMA responds more quickly to market changes than the SMA by basing the line on the newer candles. As I mentioned, there are other moving average calculations, like, for instance, the weighted moving average, but I'm not going to go into any detail about them. If you're a new trader, you're unlikely to run into them right away, and if you've been around the block, you probably already know about the ones that are important to you. If you've been on this channel for a while, you've heard me say this about moving averages. You can't tell where you are if you don't know where you've been. Moving averages get a bad rap because they are what is known as lagging indicators. But the term lagging indicator doesn't really mean what you think it means. Lagging indicators just tell you where you've been, allowing you to know where you're going. For example, if the price is above the moving average line, you're most likely in an uptrend. And obviously, of course, if the price is below the moving average, you're most likely in a downtrend. So if the price crosses and closes on the opposite side of the moving average, you're likely looking at a pullback or a reversal. That, of course, was a bit of a simplistic explanation. There's a bit more to it than that. For example, if you're in a consolidation, the price may cross back and forth over the moving average multiple times. So you'll want to include some type of indicator to help you identify the price consolidation. We'll talk about that over the next few weeks when we start discussing trading strategies. Traders will often use multiple moving averages of different lengths to help identify the trend. If you use two moving averages, one with a length of 100, one with a length of 20, you can choose to buy if the moving averages are properly aligned, with the 20 MA above the 100 MA and the price above both, suggesting that the price is in an uptrend. Now, just to save you a bit of time, you might be thinking that you can catch an early trend change by waiting for a crossover of two moving averages. The problem with that is, well, did I mention that moving averages are lagging indicators? Yeah, well, as you can see on this chart, the trend had long ago changed by the time the moving averages had crossed over. If you want to use moving averages as a buy or sell trigger, you're better off looking for the price crossing over a moving average rather than the moving averages crossing over each other. One last thing about moving averages, they are good for things other than the price. As many of you know, I use a simple moving average over the volume. Without a moving average, I find the volume information to be essentially useless. Also, I've seen traders create their own volatility indicator by adding two moving averages with the high and low prices of the candles. The farther apart the lines, the higher the volatility. I think it's a pretty cool idea, actually. And that's it for today's video. Next week, we'll look at some pattern trading strategies. Come back Friday for my strategy of the week, and next Monday for my trade picks. My videos come out at 3 p.m. New York time on those days, as long as things don't go wacky here, you know. Don't hesitate to ask any questions you may have. Remember, the only stupid question is the unasked one. If this video helped you, smash the like below. Subscribe and hit the bell if you want to be notified of our videos in the future. Have a great Wednesday, and I'll see you Friday.